Good afternoon, everyone. My name is Greg Byra from Resource Consulting Group. I want to welcome everyone to our webinar titled A Resource for Your Financial Future. The webinar should take about 30 minutes to complete, and then we're going to actually follow that with a Q&A session. So throughout the presentation, if you do have questions, you can actually type them into the Q&A panel. You'll see that at the top of the screen. There's an icon up there. Also, those questions are only viewable by the presenters, just to let you know that. The first word in the name of our firm and also the first word in the title of the webinar is resource. So I encourage you, please utilize this as a resource today. If you have questions, feel free to type those in. So let's get started. We have two presenters today for the webinar. The first being Linda Palonen, Linda is originally from Finland. She's a lead advisor with Resource Consulting Group. She received her bachelor's degree in finance and her MBA from Stetson University. She's also a certified financial planner. Our second presenter is Frank Garcia. He's originally from the Miami area. He's an associate advisor at the Resource Consulting Group. He earned his bachelor's degree in finance from the University of Central Florida. In addition, Frank completed his certification as an accredited investment fiduciary and is also a certified financial planner candidate. So with that, again, I want to thank you very much for attending, and I'm going to turn it over to Linda Palonen.
Thank you, Greg, and good afternoon, everyone. I will start with an agenda for today's event. We will be covering 4 topics today. The first will be an introduction to our firm, followed by a foundation for financial success, what are the costs of not having a plan, and how can I start saving and investing now. Also, at the end of our presentation, you will see a survey pop up. Please feel free to share your thoughts with us. All feedback would be greatly appreciated. Resource Consulting Group is a fee-only investment advisory firm founded in 1988. Fee only means that the only compensation we receive is directly from our clients. No commission, no sales tricks, no hidden fees. We offer straightforward and transparent investment solutions for our clients. RCG is also a fiduciary, meaning that we put our clients' needs ahead of our own. In 2008, we were recognized by the Center for Fiduciary Excellence for our commitment to this high standard and have held the certification for the past 6 years. I believe one of the greatest benefits of being a client at RCG is the knowledge that you can gain from us. We offer an educational approach to investment management and financial planning. The most important thing we do is to make sure our clients understand what we do, how we do it, and more importantly, how it helps them to reach their investment goals. We have grown into one of the largest fee-only advisory firms in the state of Florida and currently manage over $1 billion in assets under management. So let's begin. Picture your financial future as a mountain you're climbing. The goal, of course, is to reach the summit, which in this case is financial independence. What does financial independence mean? It means you have sufficient personal wealth to live without having to work actively for basic necessities and without needing to cut expenses down to the minimum. For most financially independent people, their assets generate income that is greater than their expenses. What you're doing during the foundation years is vital to how successful you are at reaching the summit. What you are doing now is setting the foundation and building the fiscal habits that you will need throughout your accumulation years, which represent your work career. The foundation, in a sense, is making sure you have the proper equipment, methods, and training to climb the mountain to financial independence. The accumulation years represent the actual climb. Depending on your financial goals, the accumulation stage could be 20 years, 30 years, or even more than that. These are the years when you have steady income and the ability to save money or accumulate for the future. So today, we focus on the foundation. Our future webinars will touch on important factors relating to the accumulation years and how to reach your full financial potential. There are 4 key elements to successful financial foundation. The first element is education. So if you're viewing this webinar today, you are taking a positive step in relation to education because you chose to learn how to help secure your financial future. The second element is understanding your current financial situation. You have to know where you are to know where you're going. The third element is goal setting. These goals can be as ambitious as you like. An example goal would be to have $2 million of investable assets by age 50. As long as you have a way to incorporate element 4, which is tracking and monitoring your progress toward your goals. Of the 4 elements listed, tracking and monitoring will take the majority of your time, as it will continue throughout the rest of your life into the accumulation phase and the financial independence phase as well. How do you understand your current financial situation? Budgeting. Budgeting can be time-consuming, and it isn't the most enjoyable way to spend your free time. Try to remember the big picture, though, while you're going through this step, which is that you're investing in yourself. If you start off on the right foot and live within your means from day one, it makes it much easier down the road to continue those habits and build a solid financial future. As I go through the numbers above, I want you to use them as a guide. They have relatively large ranges that should be followed, but of course every financial situation is different. We have this organized from left to right with home expense, fixed monthly expenses, lifestyle, and savings. Also, the percentages are based on after-tax take-home dollars. So if you are making $36,000 a year after taxes, that equals about $3,000 a month of income. A home expense includes your mortgage or rent and home repairs. This should be no higher than 35% of your income. Fixed monthly expenses should be around 25 to 35% of your income. This category includes your various monthly bills, including any debt repayment. You will also notice groceries as a fixed monthly amount here, as it is vital to set a food budget to keep that cost manageable as well. The third category is the lifestyle category. This should take up no more than 20% of your monthly earnings. This category contains all other expenses relating to your life choices. Here you will find something as simple as Starbucks. Spending only, let's say, $5 a day at Starbucks can add up to easily up to $150 a month. So I know it's a small habit, but it can cost you a great deal in the long run. It's important to make sure you capture all your outflows when setting up a budget, as this tool is only as valuable as the information you provide. The last category is savings. At a minimum, you should be saving 10% of your income. A part of that 10% can go towards establishing an emergency fund if you don't already have one, or towards a 401k plan or another retirement account. If you are interested in a budgeting template for Excel, Frank has created one that is very easy to use, so please mention it to us in the Q&A box now, or you can email us after the presentation, and we will be glad to send you a copy of it. So now let's do a little exercise to demonstrate the importance of not only having a budget, but sticking to it. Let's say that right now we are starting with two things, $0 in credit card debt and also $0 in an investment account. In the first scenario, we decide that budgets are too difficult and we want to live the good life. All this enjoyment adds up to $5,000 in credit card debt. We chose this number because the average U.S. adult with access to credit cards holds approximately $5,000 in credit card debt. So let's say you have the $5,000 in credit cards, then you decide that having debt really isn't all that fun, and you start paying it off, let's say $100 a month. The average rate on a consumer credit card debt is around 16%. So that is also the rate that we're using in this exercise. Do you have an idea how long it would take you to pay off the entire balance? And how much would it end up costing you over the time period? Well, it would take you roughly 7 years to pay off the balance, and it would cost you nearly $8,300, or roughly 65% more than what you spent in the first place. Now let's go the other way. Let's say that the same $0 gets invested, and every month you place $100 to an investment account. Let's say you follow this strategy for the same 7 years, earning 7% on the investments. If you did this, you would end up with an investment account with over $10,000. That is close to $19,000 difference in your net worth just because you decided to spend. So really take time to digest this slide and the impact saving versus overspending can have on your financial future. A question then we normally get asked is, what if an emergency comes up? That's when an emergency fund comes in handy. An emergency fund is an account with funds set aside for a rainy day. It should contain at least 3 to 6 months worth of living expenses. Some people prefer it to be as much as 1 year. Having an emergency fund prevents the need for high interest debt such as credit cards, and once funded, it will provide you with peace of mind knowing that if an emergency comes up, you will be prepared. If 3 months seems unreasonably high, then start with a smaller benchmark. Say have $1,000 in an emergency account by the end of this year, which will mean saving a couple $100 a month. Once you reach that goal, aim for $2,000 and so on. As long as you're putting money aside, you're on the right track. I think of this just like a fire hydrant. It's better to have it and not need it than need it and not have it. Some examples of true emergencies are unexpected medical costs, vehicle breaking down, a flat tire, air conditioning breaking down, and especially in Florida, we all know that can be very gruesome. So with all this homework we have given you regarding budgeting, living within your means, and setting up an emergency fund, let's have Frank now show you what to do with those savings to prepare you for the long run.
Thank you very much, Linda. So now we are going to move from the hard work of budgeting and setting aside an emergency fund to seeing the results of managing your expenses and living within your means. So now we have this extra savings in our budget every month. So what do we do with it? One option that you have is a 401k account. Most employers offer this type of retirement savings account, and if used correctly, it can become a very powerful tool for saving and growing your wealth. Most 401ks also have an incentive for participating or contribute dollars every paycheck to your account in the form of a company match. On the following slide, we will show in detail how important this match can be. I would strongly suggest that if you are eligible for a 401k, contribute as much as your budget allows and at least contribute enough to maximize your employer's match. Now, if you don't know if you can participate in your particular company's 401k, feel free to ask your firm administrator or human resources retirement and benefits representative in order to help you find out. Now, if your employer does not offer a 401k or you are not necessarily eligible to participate, then you can start saving for retirement in an individual retirement account or an IRA account. These particular accounts are offered as traditional or Roth and give you the ability to set money aside now as long as you have earned income. Now, both the traditional and the Roth allow your money to grow as you invest without paying any capital gains tax, which is one of the premier benefits of these types of accounts. So what's the main difference between the traditional and the IRA account? Well, with a traditional, you get to deduct the amount that you contribute for tax purposes in the year that you actually contributed, giving you some tax relief now. However, when you do start to withdraw those funds at retirement, you will have to pay a portion of those funds to taxes. Whereas if you have a Roth IRA, you don't get to deduct the year you make the contribution, And instead, the tax benefits come when you start to withdraw the funds. As at retirement, you can start to withdraw the funds from the Roth IRA tax-free. Now, if you're interested in opening an IRA account, you actually have the ability to do so through Schwab. So if you are interested, feel free to utilize the Q&A box as well now, and we'll be more than happy to email you some information regarding that after the seminar itself. Now, one last thing in relation to these types of retirement accounts, both the 401k and the IRAs, is that there are early withdrawal penalties. So keep that in mind when you contribute to these accounts. Also, there are income limitations to taking the tax deductions on both the traditional and the Roth IRA. So you have to keep that in mind as well. And if you have any additional questions regarding those, definitely feel free to use the Q&A box to ask any of those questions. Now, the last item that we have on this slide is just a regular savings account. The reason why we have this here is because there's really no such thing as bad savings. If you are uncomfortable with contributing to an IRA account or a 401k at this particular time, then just put some money into a savings account every month while you educate yourself further and determine what the best path is for you to reach your financial goals. Now, as we previously mentioned, an employer match placed into a 401k account can be extremely valuable for reaching your investment goals. This matching amount is usually represented as a percentage of the participants, which in this case would be yourself, and your contribution. If an employer has a 50% matching program, for example, then for every $1 that the participant contributes, the employer will contribute 50 cents. Also, this money that the employer contributes is tax-free, meaning that you will not get taxed on this benefit, and you don't necessarily need to work any harder to receive it. Now, what this image illustrates is the growth of two accounts invested in the S&P 500. The light blue line represents the growth of $100 invested in stocks at the end of each month, whereas the dark blue line represents the same investment, but with the 50% employer match, which, including that match, the total amount invested at the end of each month increases to $150. By taking advantage of the employer matching program, the employee that was participating in the 401k was able to gain an additional $28,000 over this 20-year period, finishing with a balance of just under $85,000. So how did the investor do that did not get the match? Well, if you look at the light blue line, they ended up with just over $56,000 in their account, which really still isn't too bad, considering they only funded $100 a month into this account for a total contribution out of their pocket of $24,000. So their contribution almost doubled without the employer match. Now, what you'll also see is this graph shows the power of starting a savings plan early and also the power of compounding, which we're going to go into more detail now. So how important is it to start early and to make sure that time is an ally instead of an enemy in your savings accounts? Well, let's take a look. At the beginning of today's session, Linda mentioned goal setting, and that you can set as ambitious of a goal as you would like, as long as it can be tracked and monitored and stays realistic to your situation. Well, let's say my goal was to have $1 million in my investment accounts by the time I retire at age 65. That would be a specific dollar amount. It's measurable. I'm either going to reach my goal or I'm not. It's very time-oriented, as I want to hit this number by the time I turn 65. So the real question is this goal realistic to my situation? And as you can see, it really depends on when you start savings. So if your money earns 7% annually and you start contributing every single month, and you start this habit at age 25, then in order to reach that $1 million milestone, you only need to invest $381 a month, or an equivalent of $190 per paycheck if you're paid biweekly. Now, let's say you decide that it's too difficult to start saving money now, and you decide to put it off until you reach age 35. Using that same goal of $1 million, because you waited 10 years, your monthly contribution more than doubles, moving from $381 a month all the way up to $820 a month, which would be the equivalent of $400 about per paycheck. And the even bigger difference here is the total amount that's required out of your pocket to reach that $1 million milestone. If you decide to be disciplined and start saving at age 25, making that $381 a month payment every single year until you turn 65, you only need to contribute out of your pocket $182,000 to reach that $1 million milestone. Let's say you decide to wait and you don't start contributing until 35. Well, you can see if you wait that long, not only does your monthly payment increase, but the total amount of money that you have to pay out of your own pocket also increases to the tune of $112,000 more, which is almost $300,000 out of your pocket to reach that exact same $1 million goal. And if you wait even longer, well, you can see an example of how much that would cost you. Now that we've looked at this theoretical 7% return example, let's see how this would actually operate in the real world as if you were contributing when you were 25 as opposed to 35. So here we have two examples that we're going to go over, an investor A and an investor B. Investor A began investing in stocks at the beginning of 1994. So let's theoretically say investor A and B are both 25 years old in 1994. Investor A invests $2,000 each year for the next 10 years, which would be an equivalent of about $160 a month, and then allowed it to grow for an additional 10 years. So funded it from 1994 to 2004, chose not to withdraw any funds and let the money grow for 10 years, but did not make any further contributions. In his example, his $20,000 that he initially put into the account grew to just under $64,000, which is more than a tripling of his money. Now, if we look at investor B, what they chose to do is not start investing until 2004, which would be when that investor would reach 35 years old. And in 2004, that investor began investing the same $2,000 each year, so the same $160 each month, and he would put it in for 10 years. As you can see, investor A and B both contributed the same $20,000 out of their own pocket, but because investor B waited that 10 years to start, his funds only grew to $34,000, showing the power of starting early. Because investor B started 10 years earlier, he was able to accumulate $30,000 more than investor B while investing the exact same amount out of his own pocket. So the main takeaway here is that time can be your greatest ally or your greatest enemy when it comes to savings for retirement. And when you first enter the workforce, you get the choice to choose which one it will be. Now, we're hoping that you got a few things out of this seminar, and some of the key takeaways that we have for you is that, first, failure to plan is planning to fail. If you choose not to plan, then you're really setting yourself up not to be successful in climbing that mountain and reaching financial independence. Second is that you must get an action plan together today to reach your goals for tomorrow. As you saw, the longer that you wait to start contributing to your retirement plan, the more it truly does cost you out of your own pocket. Third is that saving a small amount monthly really does add up. And the easiest way to meet your long-term goals, no matter how ambitious they happen to be, is to start saving early. And lastly, and most importantly, the reason why we go through all this work, go through the budgeting, go through the discipline of saving money, is to ensure that we are prepared for the future financially, which will give you the peace of mind that while you still need to manage and track and monitor your finances, you don't necessarily need to worry about running out of your finances and ending up not having any assets. Now, before we answer some of the questions that we received throughout the seminar, I wanted to share a few books with you here. Our future seminars are going to focus on the accumulation phase and touch on our investment philosophy here at Resource Consulting Group. These two books are a great introduction to how we invest and how you can manage your money to set you up for success in the long run. If you are interested in a copy, please feel free to mention that in the Q&A box if you would like to now, or email myself or Linda, and we can send you a copy of these books free of charge. And you see there our emails listed. Now, if you give us one moment, we're going to look over some of the questions that we were asked throughout the seminar. All right, so one of the questions that we received has to do with 401k and whether you should contribute to it, whether you get an employee match or not. In our opinion, we think that you should choose to participate in it anyways, regardless of whether you have a match. And the reason being is that it automates your savings plan, and you won't miss that money as much if you never receive it in your pocket. So if you choose to invest in the 401k, obviously, you would want to try and choose index funds if they're available or low-cost investment options, but we still feel it's a good idea to go ahead and utilize that 401k so you can automate your savings plan and set yourself up for success now. All right, another question that we have here is, how do I make the choice of either renting or buying a home or apartment? So really, this comes down to how stable you feel you are geographically. So if you think you're going to, let's say, live in Orlando for a sustainable amount of time, your job isn't planning on relocating you, you're not planning on moving closer to family or anything like that, then you might want to consider purchasing a home. The number that we look at is if you're staying in Orlando for more than, let's say, 10 years, then it might be equitable to go ahead and look at purchasing a home. If it's going to be somewhere under 5 years, then rental might work out better for you. I would strongly suggest following up with us after the seminar with an email if you have a specific situation that's relating to whether you want to rent or buy an apartment or home right now.
Another question we had was regarding the emergency fund and how should that be, what kind of account that should be in, or if should get invested or not. The best account option for emergency fund is just either a regular savings account or a money market account in your bank, or Vanguard offers very good solutions for money market funds. Interest rates right now are very low, so it's hard to find any savings accounts that will pay you any meaningful interest. But I would say if you have a checking account with the local bank, just either open a savings account there, look for a money market fund that is a viable option within that bank, or Vanguard. And we can definitely send more information on those Vanguard funds to you guys as well if you're interested.
All right, we have one more question that we're going to answer here, and then if you did ask an additional question, we will be emailing you a response directly. So if we did not answer it during the actual seminar, we will get to it. The last question here that I'm going to answer is, we had a participant ask stating that my rent is already higher than the recommended range in the budget that you presented, which we had a range there of up to 35%. And their question is, what should I do in this situation? And really, as we said, the range is a good benchmark, but everybody's situation can be a little bit different. The main thing you want to make sure of is no matter how much any of those categories get skewed, that you still manage to put at least 10% of your income into your savings accounts or into your retirement accounts. So the real key is make sure that no matter how much one of those categories may be inflated compared to what we were recommending, that you still put at least the 10% into your savings account every month. And with that, I want to thank you very much for taking the time to speak with us today. Just a reminder, there will be a survey that will pop up as soon as the seminar is completed. Feel free to share your thoughts regarding this presentation, and we look forward to hearing the feedback. Thank you very much for your time, and enjoy the rest of your afternoon.